Hello everyone and welcome to the earnings call of HDFC AMC. We have with us Mr. Milind Barve, Managing Director, Mr. Piyush Surana, CFO, and Simal Kanuga, the Chief Investor Relations Officer. I would request Mr. Milind to share his initial thoughts on the results, post which we'll open the floor for Q&A. Over to you, sir.
Thank you, Praveen. To everybody, welcome to this call and thank you for joining in. The presentation for the quarter ended September 30th is available on our website as well as that of the stock exchange. I hope you had time to have a quick look at it. We have just come to an end of an interesting quarter at 30th September where we did see turbulence both in equity and fixed income markets. Equity-oriented mutual funds continue to see healthy flows. For the first half of the current fiscal year, the industry has seen net flows in excess of over 700 billion or about 70 crore plus of flows. SIP flows continue to remain stable even in difficult times, and this, in our opinion, is definitely a very healthy sign. Now coming to us. For the quarter ended September 30th, we saw a growth of 9% to our overall AUM and 20% for our actively managed equity-oriented AUM. Our market share both in overall AUM and actively managed equity-oriented AUM stands at 13.3% and 16% respectively. This is more or less similar to that of the quarter ended September 2017. At a 16% market share in equity AUM, we continue to remain the largest equity mutual fund manager. In terms of the asset split, 51.9% of our assets are contributed by equity-oriented assets as compared to 44.4% for the industry. So we continue to maintain a very favorable asset mix. Our key focus area, that is individual customer accounts, continue to grow. We have seen a year-on-year growth of 24% in terms of individual customer accounts. Furthermore, individual monthly average assets AUM now accounts for 64.5% of our total monthly average AUM. The number for the industry is 53%. We are happy to state that we continue to remain the most preferred choice of individual customers and have a market share of 15.1% of the individual monthly average assets under management. We would also like to present some interesting data on unique customers as identified by unique permanent account numbers. As on 30th of September 2018, the industry has 18.4 million unique customers. We have 5.08 million new customers. This is almost 28%. To put it in other words, out of every 100 investors who have invested in mutual funds, 28 have invested with us. The unique investors for the industry over the past 1 year have grown for the industry by 25%. As for us, it has grown by 27%. Our systematic transaction book is healthy and was about 11.47 billion rupees for the month of September 2018. In terms of market share in B30, we continue to retain our number 2 position. We would like to use this opportunity to give you a quick overview of the recent regulatory developments. Firstly, SEBI reduced the additional TER from 20 basis points to 5 basis points with effect from 30th of May 2018. This has already been done. So there was effectively a reduction of 15 basis points in the TER effective 30th May 2018. We have passed the entire impact of 15 basis points by reducing distributor commission. Hence, there's been no impact on the AMC due to this change. SEBI has come up with some further amendments starting from October 22nd, whereby they have, amongst many things, they have done 2 or 3 important things. Firstly, they have banned upfront commissions. Secondly, all expense related to a fund are now mandatorily required to be debited to the scheme accounts and cannot be accounted for in the AMC. And thirdly, they have restricted the commissions on B30 only for inflows from individual customers. In our opinion, this will have no impact on our margins. SEBI has already announced new AUM slabs or AUM base slabs for computation of TER. The effect of the same on our equity-oriented scheme is approximately 24 basis points. We intend to pass a majority of this by reducing distributor commission. In our opinion, even after reduction, we will continue to remain competitive. We are happy to announce that we have recently won an equity mandate of $450 million from a reputed foreign portfolio investor, of which approximately 1/3 has already been funded recently. Let me turn to the financial result summary. Firstly, transition to Ind AS. This will bear some repetition, but the company has adopted the Indian accounting standard with effect from 1st of April 2018. As a consequence, the financials for the period ended 30th September 2018 are prepared under these new accounting standards. The financials for the corresponding period of the previous financial year have also been restated accordingly. As shown in slide 16, the key changes necessitated by the transition to the Ind AS relate to recognition of mark-to-market on the company's investments through the profit and loss account, a charge on account of unvested ESOPs, and consequent deferred tax adjustments. Our PAT for the quarter ended 30th September 2017 under Indian GAAP was 1,677 million, which or 167.7 crores, which has been restated to 1,794 million or 179.4 crores as shown in slide 17. This was more of Indian GAAP accounting. Now moving to the financial highlights. First half, we are at 30th September, we are halfway through our first half through the year. Our revenues from operations for the period ended September 30th, 2018 grew by 16% to reach 9,516 million, which is 951.6 crores from 8,204 million, which is 820.4 crores in the corresponding period of the previous year as shown on slide 18. Total revenue grew by 16% to reach 10,164 million from 8,746 million in the corresponding period of the previous year. Total expenses were up by 12% to 4,245 million and 3.785 million in the corresponding period last year. Profit before tax grew by 19% to 5.919 million from 4.961 million for the corresponding period, and profit after tax for the period stood at 411.2 crores, which is a 19% growth over 344.4 crores for the corresponding period of the previous year. Our operating profit from the core asset management business, after adjusting certain non-recurring expenses, grew by 24% to 548.3 crores for the period ended September 2018 from 441.9 crores for the corresponding period of the previous year. The above adjustment is on account of estimated provision in the current quarter towards impairment of certain investments. For the second quarter FY19, our revenue from operations for the quarter ended 30th September 2018 grew by 12% to reach 480.4 crores as compared to 430 crores in the corresponding quarter of the previous year. This is shown on slide 19. Total revenue grew by 13% to reach 5,153 million from 4,576 million in the corresponding quarter of the previous year. Total expenses were up by 13% to 2,181 million from 1,934 million in the corresponding quarter last year. Profit before tax grew by 12% to 2,972 million, that is 297 crores, from 2,642 million or 264 crores for the corresponding quarter. The profit after tax for the quarter stood at 205.9 crores or 2,059 million, which is 15% growth over 179.8 crores or 1,798 million for the corresponding quarter of the previous year. Our operating profit from the core asset management business, which is the most important part of the presentation, after adjusting the non-recurring expenses, grew by 20% to 283.5 crores for the quarter ended 30th September 2018 from 236.6 crores for the corresponding quarter of the previous year. Our operating profit margin, which is the operating profit as a basis points of the average AUM, stood at 34 basis points for the half year ended 30th September 2018. This is on slide 20. From the corresponding period of the previous year, this was 33 basis points. These were my opening remarks. We would be now happy to take questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Subhranshu Mishra from Motilal Oswal Securities. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. My question relates to the liquid funds which have been in question over the last 2-3 weeks. So what kind of flows have we seen in the first 15 days of October, and how do we look at the flows in November and December for the liquid funds going forward, sir?
Okay, so let me first tell you that our liquid fund, which used to be averaging somewhere in the region of about 45 to 50,000 crore, is reached an unprecedented level of about 75 to 80,000 crores in the month of October. So we have seen exceptionally strong flows in liquid funds in the current, so about 25-26 days of the current month. We have gained market share. Is our understanding is that we have gained significant market share as people have invested in our funds because they appreciate the performance and they like the composition of the portfolio. I would expect, barring anything particularly unforeseen, that we would probably retain a reasonably high market share as compared to the previous quarter, through the entire current quarter, going forward into November and December.
And on an industry level, do you think that the flows are coming back into the liquid funds, or is it just that we are gaining market share out of the rest of the guys?
My sense is that from the flows that went out in the month of September, largely on account of quarter-end considerations, advance tax payments, and so on, some part, my guess is somewhere between 60 to 70% of that money has probably come back. It may not be entire 100%. But clearly, we are seeing significantly high market share in terms of the entire liquid fund business itself.
Right. And just to squeeze in a second question, any of your large distributors like national distributors, complaining about the entire TER which has been passed on?
Obviously, like a reduction in commission is not welcomed by any distributor, and it is also difficult on our part to be having to take these steps. But I think it would be fair and appropriate that I think the distributors have largely accepted the change, because our understanding is most of the players in the industry have also been able to do the same.
Right. Sure, sir. Thank you for your time.
Thank you.
Thank you. The next question is from the line of Rohan Advan from Multi-Act. Please go ahead.
Sir, thanks for the opportunity. Sir, I just wanted to understand these non-recurring expenses. If I work out the numbers, I think there is a 21 crores non-recurring expense in Q2 FY19. So if you could throw some light on that.
Yeah, surely. So the non-recurring expense of 21.2 crores reflects the impairment that we have taken on one exposure that we had in the AMC balance sheet in our investment portfolio. We had some exposure to ILNFS. We have written off more than 50% or approximately 50% of that exposure, which was in the form of preference shares. After writing off that exposure, our balance exposure is now only 18 crore rupees in the form of preference share of ILFS. This is in the books of the Asset Management Company, and this is only 0.7% of our total investment book as of now.
Okay. Thank you. That was the only question I had.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Amit Nanavati from Nomura Securities. Please go ahead.
Yeah, hi, sir. So last time around, we've been discussing around we intend to pass on the full TR cut to the distributors, but you want to opt a different strategy for a stock and an incremental flow. So anything that you have on that? So incremental flow also fair to assume that, 50-50 kind of pass on would be something that you're looking at, or you'd be looking to pass on fully?
I think first of all, the change in the TR has not yet been announced other than the press release from SEBI, so the effective date is still unknown. But our understanding is that we should be able to pass on most of the reduction in the TR as far as the book is concerned. So that is, as far as the impact on the AUM should be reasonably small, if at all there is any. That is number one as far as passing down the reduction in the TR on the AUM book of equity AUM. As far as the commissions on the sales are concerned, my understanding is that the industry is trying to arrive at a reasonable share of what the TR should be. That should be shared with the distributor as commission, and what should be the share of the TER, which should be retained by the asset management company. And I think we would largely be deciding in line with what the industry does so that we remain competitive. My sense is that this formula of what would be paid and what would be retained might settle somewhere between 55% of the TER, of the new TER to be paid as commission and 45% to be retained, or it could be somewhere in the region of 55 and 60% to be paid and about 40 or 45% to be retained. I'm talking broadly of what I expect where it to be settling down.
Understood. Just one more thing on the B30, right? So with the recent changes, basically now only individual assets will be qualified. So overall our 16% B30 share, that basically on a retail asset basis would be much lower, right? So how does that change the whole economics around it?
My understanding is that it does not change the first thing first. As far as the P&L is concerned, the B30 commission is a full, the B30 TER is a full pass-through. So basically whatever extra we pay to the distributor for bringing us the retail business from the B30 towns and is what we can charge to the customers. So it is first of all a 100% pass-through. It does not have any impact on the profit and loss account of the company. Having said that, my understanding is that they are only plugging possible abuse, that in case there is a corporate entity or if there is any firm or a company or a body corporate which is based in a B30 location, which is also business from which is also enjoying the B30 additional commission only, that gets stopped. But largely, as you know, this is in equity-oriented schemes where predominantly flows come from retail investors. So my sense is that 16% or 15-16% may come down only marginally, because I don't think the corporate business or any kind of institutional business is very strong in the B30. So that is not going to make a very material impact on the percentage of the business that comes from the B30.
Got it. Just wanted to check because in case if we fail to achieve that B15 on a pure retail basis, then we'll not get that additional 30 basis point. In that scenario, to pay out to the distributor for the added cost that they might incur would become much more challenging, right?
No, not at all like that. I just want to clarify it again. We will not be able to charge extra B30 to TER, but then we will not be even paying on that additional TER. We will be basically whatever we pay as extra commission for getting business from B30, what we pay is what we charge as TER. If we pay less, we charge less. So it is completely neutral to the P&L of the AMC.
Sure. Thanks a lot, sir.
Yeah.
Thank you. The next question is from the line of Harish Kapoor from IIFL Asset Management. Please go ahead.
Hi, sir. Just first thing, coming back to the non-recurring expenses that you mentioned, there's an 18 crore balance there. How do we kind of look at that? Do we kind of recognize that also as, in terms of the exposure that we have to write off, or how are we looking at that part?
No, I think we have been conservative because it is basically a function of the loss given default that we have to consider how much we want to write off, but we have actually been conservative. We have actually already taken up more than 50% write down of that particular investment. So we are now left with only a small residual portion of 18 crores or 18.8 crores. So given the size of our investment book and the size of our, the revenues that we make, we will evaluate it at the end of every quarter, and if we believe that we need to make some small incremental provision, we might make it. It will be something that we will take a call every quarter based on what developments are happening with that particular exposure. But right now we think we have done as what was required, or even more than that. We have been conservative in taking more than 50% write down.
And this is to which entity of INFS? The holding or some of the other subsidiaries?
This is a preference share, the holding company.
The holding company. Yeah. Okay. And so second thing on this TER aspect, right? I think you have, just mentioned that maybe the sharing in terms of the pass on, maybe let's say around 50, 55 or 50, 60. And, some part has to be retained, but, previously after these, some notification kind of came out, you had kind of mentioned that maybe 80% or more could be actually passed on, and, the others could be, retained by some other OPEX or some other mechanism where you would have zero impact. So, first want to understand, after that initial assessment, do you kind of stand by what you thought? And second, you seem to be more confident in terms of passing on, where 80% plus could be passed on. So, what is the reason for that in particular?
Yeah, Harish, let me make it very clear that there are two separate things. One is the reduction in the TR on the AUM book that's going to happen as and when SEBI announces the effective date. That reduction in TR, and on an ongoing basis, we did mention that almost 80-90% or more might get passed on, so there should be very minimal, if any, impact on the margins of the business. That is one aspect of it. That is the second aspect, completely different from the first one, is that how do we remunerate distributors competitively for ongoing new business flows. On that, the sharing for whatever is the TER, let's say in a product, if you are earning, say, 150 basis point, or let's say 100 basis point, then our expectation currently at least is that the industry is now coming around a view of having a reasonable sharing ratio, and that sharing ratio might settle down somewhere between 55 and 60% of the distributable TER to be paid as commission, and the remaining 40-45 basis points to be retained by the asset management company. So in that sense, nothing is really changed from what our earlier view was. We have already implemented, what is already behind us is actually the change of 15 basis points. That we have passed on 100% by reducing the distributor commission.
Okay, and just for the reason that you're more confident of passing on such a high percentage, because some of the larger AMCs are obviously talking about a lower number. So for you, any reason for that? Because some of the other large distributors, I think we had some, there were other calls from the advisors, and obviously they are communicating that they will not like to take the hit that is being spoken about. So any reason why you are more confident, or just the reason as an institution, that's the reason or something?
No, the reason I'm reasonably confident about this is because the commissions that we are expecting that will remain in the business will be very competitive vis-a-vis the other AMCs, what they will be paying. And I think they will be within the band of what is the reasonable expectation. In fact, if you look at commissions that are paid out today, we can't compete with somebody who's paying out the highest commissions in the industry. But the commissions that we pay have to be within a certain band or an acceptable band, acceptable both to the distributor as well as to the asset management company. And we are confident that we will be within that band, or that will be seen as acceptable by the distributors. We will communicate with the distributors and engage with them. I think the relationship is not only a matter of commission or whether you're paying the highest or the lowest. We have to be competitive in line with what others are doing, which we think we will be able to achieve over time.
Okay, sir, and just in terms of the other income side, do we believe that we could maintain the same run rate even, let's say, for the year and for the next year also?
So there is only a small part of our investment portfolio which has a very significant mark-to-market, which is our exposure to the fixed income market. So a significant amount of our portfolio, almost close to about 80% plus, is in portfolios where there is less vulnerability or no vulnerability to mark-to-market, because that is held in the form of investment in liquid funds, arbitrage funds, tax-free bonds, and FMPs. So here the mark-to-market risks are very low, if at all there is any. There's only about 16% of our portfolio which has exposure to debt products, which are our own debt funds, where there is some degree of mark-to-market. So I would largely expect the run rate to be broadly the same, unless there is a very significant change in the interest rate scenario, like we did witness in the first quarter. But otherwise, this quarter, it has kind of become normalized, or it has become...
Okay. So we expect the same 30-35 crore run rate in short for this.
I don't think we'd like to put a number to it.
Sure. Okay, and last thing, in terms of the mandate that we have got, obviously it's very good to see this. So any color that you would like to kind of give on this, and any other pipelines or any other communication that would be possible in this?
No, I think it's a very significant win for us in this quarter. It's a $450 million mandate. As you expect in such large mandates, we are bound by non-disclosure understanding with clients about both the client name as well as terms and conditions.
Okay. Fine, sir. That's it from my end. Thanks and congrats.
Thank you.
Thank you. The next question is from the line of Ojasvi Kicha from SBI Cap Securities. Please go ahead.
Yes, thanks for this opportunity. So my question is specific to SEBI circular, where you have mentioned 3 key points and resultant impact of about 24 bips. So if I understand correctly, there was, one more, key point which was regarding the, payments for direct versus regular plans, wherein so there will be like direct plans under, including the investments and advisory fees. So they can't be charged more, expenses as compared to the regular plan. So do you think it would have an impact, or how much that 24 bips can go up by if we have to include impact of even that point?
No, there will be no impact on the direct plan TER, because the direct plan TER is actually a derivative of what the TER is. So when you take the TER in what is called as a regular plan, and when you reduce the commission payout, then you come to the TER of the direct plan. So basically there is no change in the direct plan TER. So there is no question of the impact of 24 basis point being increased by any change in the TER of the direct plan. The direct plan is a TER which is derived from the regular plan TR minus the commission that is paid to the distributors. And so I don't see any change. As far as business that comes from advisors directly into the direct plan, the advisory fee is actually paid by the client. It is paid by the customer. So there is no question of that creating any impact on the total retention under the direct plan.
Sure. I'm done. Thanks.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Yeah, hi. I'm looking at slide number 10, and I'm just looking at the systemic inflows, and I think there was a slight dip on a quarter-on-quarter basis. So, am I reading like too much into it, and how do you really see the trajectory here in after?
Yeah, so let me just explain to you that when we say systematic transaction, it actually comprises SIP as well as what in India we call as a systematic transaction plan, systematic transfer plan, where people invest some lump sum amount and then slowly transfer it into any equity fund they have chosen. If you take off SIP as only people who are putting new money into our new fund house equity products, that book has actually grown every month and even in the month from September over June. But the systematic transfer plan, which is usually where people invest for as short period as 6 months or 3 months or 12 months in a liquid fund and then give a standing instruction to transfer that money into an equity fund of their choice, those are actually lumpy amounts that sometimes when the investment period chosen is completed, they tend to stop. And that is why if you see a small dip or the growth is not there, it is largely on account of systematic transfer plans having expired after having run through their normal course. The SIP book, where is people signing up new SIPs with new customers, we still continue to maintain, as you would have seen, a run rate of about 45 to 50,000 per month of new SIPs being signed every month.
Okay, so that trend basically continues. And in case we are seeing that liquid fund inflows are strong this month, then I guess possibly this again, even this number should possibly trend up next quarter.
I think so. I mean, see, a systematic transfer plan is where a customer would have chosen to invest for a very short period, 3 months, 6 months, where he's put a lump sum money. So once that 3-6 month period is over, maybe in the current volatile environment, he has not put any, or new investors have not come with lump sum investments to do systematic transfer plans. So it's more a function of STPs, as we call them, systematic transfer plans which have expired. But the momentum on new flows in terms of SIP as well as or the other flows in general seems to be continuing in the month of October quite well.
Great. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Shiva Kumar from Unifi Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, going by the SEBI circular, it seems the hit in terms of the TER or the reduction of TER in aggregate terms is higher for the bigger schemes compared to the smaller size schemes. And given that the bigger participants in the mutual fund industry have those larger schemes which they have seasoned over the years, do you think that going forward the IFAs might actually churn their portfolio towards the smaller schemes which are handled by the smaller mutual fund players? Is that a risk for the bigger players going forward?
If you ask me, it's a great question. Very recently, if you have seen, there has been another very important circular which is already in force from 22nd of October, where where asset management companies are required to only pay commissions in the form of trail commissions. So first of all, this is a very positive and important step taken by SEBI in helping to reduce the churn. So if you are an existing incumbent manager with a significant size of an existing book, your book always was vulnerable to churn or somebody paying a high 1% upfront or something higher than that and you losing the asset. Now all of us are going to be paying in future only trail form of commission. Now in a trail form of commission, even if your fund is slightly bigger than some very small fund or a medium-sized fund, the difference in the trail commission will only be 15-20 basis points or maybe a little bit more than that. And for 15, 20 or 25 basis points, there is no incentive for a distributor, including an IFA, to churn the investor from one fund to another fund. So the new announcement that SEBI made effective 22nd actually protects everybody's AUM in the industry from churn. Because, see, the churn used to happen because when there is a 1% upfront being paid as compared to earning a trail commission, there was an incentive to churn as far as the distributor is concerned. I'm not trying to say that every redemption was on account of churning, not at all. Sometimes the customer himself wants to go out from one fund to the other. But that said, if you look at commission-driven behavior, then I think the all-trail commission model will significantly reduce churn, and to that extent, an existing or an incumbent player would benefit from it. Also, if you take the long-term capital gain, it still remains at after 1 year, and it's 10%, so there's no reason why there should be churn before that. So I think if you expect now going forward, my expectation is that churn will reduce.
Thank you, sir. Sir, and you have given a fact that direct currently constitutes 17.4% of your total equity-oriented AUM. What is the number for the entire industry, sir, if you can share?
Don't have this number published very easily, but separately for equity. So my expectation, it should be somewhere in the similar 15-16% or so.
Right. Thank you, sir.
The next question is from the line of Subhranshu Mishra from Motilal Oswal Securities. Please go ahead.
Thank you for the opportunity again, sir. My question again is about the liquid funds. Any formal or informal mandates that you're getting from the investors as to invest into any kind of specific papers, or you're investing across any kind of issuances? That's the first thing. And second, what proportion of your incremental flows are going into papers which are rated below BB in the liquid funds?
BB? Below?
Maybe BB or B even.
So, okay, to answer your first question, I don't think investors are giving any mandate about where we should be investing the funds.
Okay.
There is no specific mandate in any form of what we should do or how we should manage the money. It is being managed entirely based on what our investment team and fund managers decide where they need to allocate money. I think in general, we have been very competitive in the way we have been running liquid funds. We do not have exposure to BB, you're saying, which is really a long-term rating, so it's not really relevant in a liquid fund. But I think we are investing where there is an acceptable credit. Otherwise, we are happy to stay reasonably high levels of cash or in treasury bills.
Right. And on slide 18, where you give out the electronic transaction, 64% is the electronic transaction. What is the split between wholesale and retail over here, or maybe distribution partners and retail customers here?
1 minute. Yeah, so basically, see, we get this is really relevant more for retail business, not so relevant for wholesale or institutional or corporate clients, because those are very few. Effectively, what we look at is of all the transactions that we do with any customer or distributor does with us, what percentage is coming electronically. And now we are as a second quarter, we are now at almost 64.2% of our transactions are coming on through some electronic platform. Either it is our own HDFC MF Online, HDFC MF Online for partners, which is our distributor property, or it could be coming through any other platform, like whether it could be an NSE platform or BSE platform, or it could be any other electronic platform run by a distribution company also. So effectively what we monitor is how much of our transactions are electronic and physical, and there we now are at a 64.2% of electronic transactions.
Right. Sure, sir. Thank you for your time.
Thank you.
Thank you. The next question is from the line of Adesh Mehta from Ambit Capital. Please go ahead.
Hello, sir.
Yeah.
Yeah. So, sir, I see that your equity AUM has grown by 20% YOY.
Yeah.
So how much could be the MTM impact?
MTM impact year on year?
Yes.
Let me see if I can pull out. If you see broadly 1 year benchmark returns, 1 minute. I'll just come back to you with the...
Okay, sir. I'll ask the other question.
Right.
For the overseas money you raised, what is the fee structure?
No, in this particular deal that we have won, a $450 million mandate, as I mentioned, we are guided by our contract where we can't disclose both either the name of the client or the terms and conditions. Okay, sir.
Other things are this business development expenses and other expenses of around 161 odd crores. Yeah. Is it possible to get the breakup between the marketing and distribution commission and others?
No, we don't really provide the breakup of this, as you last quarter also. However, the one-time charge that Milind has spoken about is in this expense.
Right. No, the reason I'm asking is, given that distribution is a big, cost, and it's a variable cost, it's very important for me to basically understand that, to see where the net yields are evolving. So may I request you to start disclosing this from next quarter onwards, sir?
No, I'll tell you, basically there is only upfront commission which is amortized over 12 months. That is the only thing that comes as a part of this business development, which is what you are looking for, which is commission.
Right.
Now, over a period of time, that will also go away because upfront commission are stopping only.
Okay. So you're saying that over the next 3-4 quarters, this will actually go down to zero?
Well, in a way, go ahead.
It won't go down to zero because under business development expenses, while a large chunk is the distributor commission, there are also other expenses like distributor training, etc. So some part of it will still remain.
Yeah. So that's the key question, that, how will this number move? That once you stop giving out upfront commissions, once you come on the full trail model, how should we see this expense, evolving forward?
This will keep coming down because what will be left is old amortizations, which will run out over a period of a year, and there will be no fresh upfronts coming into this.
But you're right, this upfront commission which is getting amortized through this particular account head will over a period of time become zero. But this will slightly get compensated because these people whom we are paying upfront, we may have to give them a slightly higher trail going forward. So,
right.
So that impact will come through the top line and not come into an expense form in here.
Yes. So, sir, any idea that what could the top line impact be, and then, how much could actually trickle down to the expense item as well?
See, our understanding...
Because there will be some reclassification, right? Whatever upfront you are giving right now, that would eventually come under trail going forward. And
in the long run, in the long run, I expect this to be, not even long run, in the medium term, I expect this to be P&L neutral. Because effectively we are not trying to either give more commission or less commission, where we will be trying to do a systematic conversion of the upfront into a trail.
Okay,
so we are not seeing this as some opportunity to make more margin, but we also will not be giving up margins on account of this change.
Okay, but sir, any reason why you're not disclosing this in terms of your distribution costs?
No, because it's not a single item. There are many items that go into it. There are other things which you want to elaborate.
So no, but then we do disclose that in annual report.
Of course it will be
disclosed.
Yeah,
it will be disclosed because in the annual report you'll have the whole schedule of expenses, and a lot of other expense details are disclosed there. So it will come.
So why not quarterly?
Quarterly because we don't have the schedules here. So a whole lot of things that come in the annual report are not disclosed here.
Okay, sir. I'll leave it at that. Thank you, sir.
And in any case, what Milind just said, that over a period of time, since this expense is going to move into the scheme's books, the relevance of this disclosure will also go down.
Okay.
See, finally, you are concerned with the PBT margin or what the margin in the product is going to be. And all that I'm saying is that the margin will get maintained. It doesn't matter how much will get reduced from the expense and how much will get added or reduced from the top line. What our current understanding is that this change of converting upfront into trail will be revenue neutral. So that should be sufficient in case of understanding the impact.
Okay, sir. Okay. Sir, regarding my first question, did you get the numbers on MTM loss?
Yeah. Basically, the Nifty 50 is up 5.5%. The mid-cap index is down 2.5% over the last 1 year.
12 months.
Yeah, September over September. So I think you can take the balance growth as the
net
flows.
New flows. Okay, sir. Thank you, sir. All the best.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Amit Jeswani from Stallion Asset. Please go ahead.
Good evening. Thank you for taking my question. So my first question is, what kind of cash on the balance sheet are we comfortable in to hold? Because we hold 2,600 crores of cash on the balance sheet.
Yeah, so there is no absolute number that the board has in mind as adequate or appropriate. We would like to maintain a reasonable size of the AMC balance sheet consistent with the growth opportunity of the overall business. That said, we will certainly, as we have indicated earlier, there will be an engaged debate on what should be the dividend payout or what should be the payout ratio the company should follow. At this stage, it would be only fair for me to give you the indication that every year in the last few years, the dividend has not increased, not just from the growth in profits. The dividend payout ratio also has been increased. So this has increased from almost 40% over a period of time to almost 56% in the last few years. So it's gone from 41 to 47 to 51, and then last year in FY18, the payout ratio was also 56%. So I would expect that the board would like to consider at the right time in suitable increase in the payout ratio so that we do not maintain more cash than what we think is appropriate over a medium term.
Right. So the new TR rules apply for the incremental AUM only, right?
No. The TR is going to apply for the entire existing book as well. But as we mentioned, in the entire book, we are currently paying trail commission, and after paying trail commission, we get our net fees in the form of retained fees. So our objective is that largely to the extent of the reduction in the TR, we will be reducing the commission payout, and we might take a very small impact on the margin after reducing the commission payout.
Right. Sir, and when do these rules start applying? Do you have any guidelines that we've not already cut the TRs, right?
No. So the SEBI at their board meeting on 18th of September, after that in the press release, they have already announced what the revised TRs are going to be, but they have not announced the effective date when the new TRs will be applicable. And they have still not announced the applicable date from which it will first begin to start operating. So we have no idea of when the effective date of this new TR or the reduced TR is going to be.
Right, sir. Thank you so much. Thank you.
Thank you. The next question is from the line of Dev Trivedi, individual investor. Please go ahead.
Good evening, sir. My name is Sid, and my basic question is that is a missing point of operating profit margin in press release as compared to Q1's press release. Can you please guide me the margin, increase of margin?
Hello. Let me just understand your question. You wanted to comment on the...
I was going to the Q1's press release. There was a particular point of operating profit margin, which is operating profit as a basis point of average AUM, improved to 35 basis points. It is missing in Q2's press release. Is it available?
No, it's not.
Can I get it?
It's not in front of me, but let me put it this way, that we are now at the middle of the year, so we thought it would be more appropriate to share a 6-monthly operating profit margin rather than breaking it up quarterly or so. So as we go forward, we will keep giving you a year-to-date operating profit margin, which will help you a little bit more understanding clearly rather than any quarterly trend. And these things will not see very small quarterly trends because it's a very short period to actually come to an understanding of what is happening to operating profit margin. So the longer the period that we announce the operating profit margin, the better it is. It's a more robust number. So that is why we have chosen to announce the half-yearly operating profit margin, which is improved by 1 basis point from the similar 6-month period ending 30th September 2017.
Okay, thank you very much.
Thank you.
Thank you. The next question is from the line of Nilesh Shah from Edelweiss. Please go ahead.
Hi. Just one point that, am I audible?
Yeah, I can hear you now.
Yeah. Hi. So when you look at the financials of the scheme which you have in your website, right? So over there also you have in your expenses section, you have a field called commission to agents, right? And when you look at the financials of the AMC, then in your other expenses you have a field called brokerage incentives, right? Is it correct to say that what we see on the scheme is the trail commission and what we see on the AMC is what is the existing upfront structure? Is that the correct, understanding? Or
Nilesh, you are absolutely right. What you see in the scheme is essentially the trail commission. What you see in the AMC is the amortization of the upfront commission. You are absolutely right.
Okay, great. So just to understand this thing correct, a bit more, when you say amortization, can you just help me understand over the, typically what periods would you amortize on? Because I couldn't find...
We have consistently followed a policy where the upfront commission is, in an equity fund as an example, is written off over the next 12 months. Because we have a clawback. So the upfront commission is more like advanced trail. So whenever the asset, if it is churned out or taken out, we are able to then recover the extra upfront commission that is paid up to 1 year. So that's what I mean by amortization of upfront commission. It means the amount that is written off to the P&L of the upfront commission, which is typically over a period of 12 months. And the reason for why it is 12 months is because this commission can be clawed back if the asset is withdrawn by the customer.
Right. Great. Just to follow up on this, it's like I think you spoke about it briefly, but so now that upfront commission is kind of going away for the whole industry, right? So is it fair to say that the commission to agents that you see in the scheme would go up and corresponding management fee will compress, right? Is that the way it will work out?
You're broadly right, Nilesh. The management fee, when they inform the top line, might come down a little bit because we'll increase the trail. But in the P&L debit side, on the cost side, the upfront commission that is getting amortized, that over a period of time will actually become zero.
Okay. Is there any other expenditure you have, in your, other expense field, right, which you could argue, right, is say not fixed or say is somewhat linked to either new inflows, things like that. So just trying to get a sense of how much of your other expenditure is fixed in nature and how much is kind of variable.
Actually, if you ask me, the commission is the only one which is variable. It used to be variable to the AUM for trail, and it used to be variable to the gross sales as far as upfront is commission. Going forward, the only part that will remain will be the trail commission, which will be based on the AUM, which is much more consistent with our revenue recognition. There is not much other expenses, which is, in fact, I can't think of anything else which you could treat as variable expenses. Okay. So the operating leverage on the business remains very strong because as we grow the business and grow the fees, the expenses other than commission don't grow up in the same proportion.
Right. And sorry, just one last thing. You mentioned something about, basically assets that you already have, so existing investors and your new investors, right? So when you, so incrementally as you basically renegotiate, right, with, with your distributors, right, do you expect any form of skew between how the payout structure may look on your existing book versus new flows?
No, I don't think it will align what we are paying to on the book as well as what we are paying to new business. So we will basically, the exercise that we are in the midst of is to align the commissions that we pay on the new flows as well as to what we are already paying on the book. So I don't think there will be any major alignment. For example, one of the sort of the upper end of what their commissions are to a particular distributor in the upfront commission will get a similar better commission in the in the upfront commission will get a similarly better deal in the trail commission. So I think we will align the payouts on the book along with the payouts on the new flows also.
Okay, great. That's all I had on my end. Thank you so much for clarifying.
Okay, thank you. Bye-bye.
Thank you. That was the last question. I now hand the conference over to the management for their closing comments.
Yeah, so once again, for all of you who have been on the call, thank you very much for your interest and for being on us on this call. It's clearly been an interesting and a rewarding sort of quarter for us and a half-year period which has ended on 30th of September. Once again, on behalf of my team, thank you very much for being on the call.